Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as Wealth Advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm your co-host, Steve, and here we are, guys. This recording is coming out here on December 31st, the last day of 2025. So are you guys ready for wrapping up this year and making sure we got good momentum going into 2026?
Mm-hmm. I'm ready, Steve. I think I am. You know, we've been doing this program for 10 years now, and we've had plenty of times to talk about the coming year and some of the things we have, we want to focus on, and maybe almost as importantly, some of the things we want to make sure aren't distracting us for the year ahead, and really focus on those things very intentionally that are important to the quality of our lives and those that we love and that we care about. So how about you? Are you ready?
I'm ready. Yeah.
Well,
yeah.
ready or not,
it's coming.
That's right. That's right.
Yeah. No, I'm looking forward to it. In fact, one of the things I always spend a lot of time in reflection in the month of December and the beginning of the new year, like many people do. And one thing that I'm definitely going to do in 2026 is I'm going to get back to writing. And up until February of 24, I was doing a lot of writing, and then life got super busy and I stopped one of my newsletters, and just because I was so busy with other stuff, and thought it was just a very short temporary hiatus as we relocated across the country, and that hiatus turned into almost 2 years. And so I decided I really want to get back to writing. So that's one of my big things for 2026 is just to do a lot more writing and even more podcasting as well. So looking forward to doing even more of those things in 26.
Awesome. Well, we've certainly kept you busy here with our podcast cadence. You know, we've come out with one every 2 weeks for 10 years. So that's 252 episodes now today as we produce this show. So thank you for allowing us to be one of those things that you're intentionally deciding is productive for your life.
Well, it absolutely is. It's one of the things I look forward to. So I appreciate you guys welcoming me into the family here, so to speak. So it's been great. Looking forward to it. Well, we've got something that I want to continue from the last episode. So we ended the last episode with a bit of a teaser, and I had asked a question and gave you guys two options and was interested in which of the two options that you would choose. So I'm just going to remind folks what the question was. So the question is, you have two options. Option one is you know for certainty, with certainty, that you are going to die the night of that you turn 78 years old. Now, the good news about that is you have perfect health up until that age. So there's going to be no suffering. You're just going to go to sleep and you're just not going to wake up. Okay. But perfect health up to that point. That's option one. Option two is you say, I'm just going to roll the dice. I'm just going to take whatever life throws at me. Maybe I'll be healthy. Maybe I'll live past 78. Maybe I won't. Maybe I'll, suffer toward the end of my life. Maybe I won't, but you're just going to roll the dice. So curious, since you guys have had a little bit of time to think about it since we last had that conversation, which option would you take? Option one, the certainty of I'm going to die healthy, but die at 78, or I'm just going to roll the dice and see what happens.
So I can tell you, Steve, I thought about that some since we talked, and I think there's real power in us not knowing what the future brings. I just think there's real. I think if we knew exactly how things were going to play out, I think it would be a very, very different world and a different life. So I suppose, roll the dice. Now it's easier to say when I'm 57. Of course, it'd be maybe different.
I think it goes the opposite.
If you're 38, I mean, of course, for our viewers and listeners that are 77, I think it might be a little easier to make this decision, but I would rather not know. Frankly, now, hey, this is just how my life has worked. I've been very fortunate. It's not that there haven't been bumps in the road and ups and downs. Certainly there have, and difficult things to travel along the journey, but things have typically worked out better than I could have ever imagined along the way. So I'm going to stick with taking the chance and do the best I can with the things we can control, which we talk about here on
That's
the
right.
program all the time, with health and relationship and physical, mental, emotional, spiritual health and those kind of things, and let the chips fall where they may, as they say.
Okay, excellent. Matt, what about you? What are you thinking?
I agree. I don't think I would want to know. I mean, really thinking about it, I think that would encourage some, I would say, some bad behavior. Not not in a negative,
Like, right. Reckless, like,
very,
I know I'm not gonna die, so I think I'll, like, go
yeah,
skydiving or something.
Yeah,
yeah.
and then the last few
Go
years it'd be
skydiving without a parachute. Just keep
Oh, there you
testing the
go.
limits.
Yeah,
It doesn't
that's
sound
right.
like that's probably the
iteration.
right way to go about living. And two, you would say, okay, because part of me is like, well, what would be in the fun in knowing? Because you have to plan and make decisions and things like that. Maybe that some of those things don't change, but if you just knew you weren't going to die, I think that just might put yourself in some weird situations because of that.
Yeah. Yeah. Well, I'm with you guys. I would definitely roll the dice there and just let the chips fall where they may. So I asked a variation of this question recently to another gentleman, and the variation is, what is the youngest age at which you would take the certainty bet? Right? So instead of 78, you guys aren't, none of us are taking it at 78, but would we take it at 85? Would we take it at 92? So I asked this gentleman that question, and he said 105.
Okay.
And I said, well, why 105? He says, well, I really want to live to at least 100 because I just want to see what it's like to be a century old. And so he said 105, which, yeah. So I'm hitting you cold with this variation. Is there what's the youngest age at which you take the certainty, or you're like, hey, I'm not even going there. I'm just going to roll the dice, period. There's no age where I would take the certainty because I, as you mentioned, Bill, it's like, and Matt, it may cause you to, live your life differently, or that's just not how I want to go through life, knowing that I'm going to die on this day.
I know. Yeah, it's weird to think about. And fortunately, we don't have to worry about it, but
That's right. Well, you've seen some of these eccentric, possibly billionaires, and not to say that because someone has resources that they're good or bad, right? I mean, we've talked about on the program that we think that financial resources make you more of what you already are. So it doesn't mean just because somebody has done well that they're innately bad or arrogant or
better,
eccentric, or we talked about Warren Buffett, I think, on our last program, and being someone who's done a lot of good with his wealth, employing lots of people over the years, and very generous as well, philanthropically. So, it's but with that said, there are a few out there bantering around living forever. Have you heard a little bit of this? That there's with the science that we have today, that people can live forever, and I think there's somebody out there doing something now. I think an influencer, as they say. I think maybe someone very wealthy who's living like. Have you seen this, Matt? You might know this person.
I think his name is Brian. I think his first name is Brian.
He's sleeping
a little intense.
Sleeping 10 hours a day, eating it's just extremely
over 100
rigorous.
supplements a day.
All these supplements.
Yeah, biohacking. Yeah.
Right.
Yeah.
And however that ends up working out. So, hey, I'm not judging anybody here. So you've talked about return on life, but the quality of life, not necessarily the length of life. So imagine if you gave them 105 and you actually could have gone a little longer. Again, not trying to live forever here.
Right.
But I think there's I'm going to go with whatever the plan ends up being and do my best. That's what my answer would be.
Yeah, that's what you're going with.
Yep. Still let the chips fall where they may.
Yep.
Yep.
Steve, I mean, you're looking like you might be thinking 105 or something along those lines.
I think it would be over 100
Okay.
before I would. But yeah,
Okay.
I'm like, do I even want to know the day I die? I don't think I do.
I don't think we do. I think there's
I don't think I do. Even if it was over 100, it's like, I don't know.
I think there's a lot of power in the not knowing. I do.
Mm-hmm.
So
yeah.
All right. Well, maybe we piqued our listeners here on and viewers on the beginning of a new year to consider these types of things.
Mm-hmm.
We always talk about living intentionally and thinking about what's most important to you in your life, and because we live in a material world, so it does require dollars to operate.
Yep.
So it ties in with our program and that idea of purpose. I mean, when we're putting together a financial plan for somebody, it's all driven by the purpose, their purpose, what's important to them, what are their fears, their desires, their passions, their joys, their aspirations, building memories. I mean, all those things.
Well, speaking of financial stuff, I know we've got a couple things we're going to touch on here today. One is Dow 100,000. I think we touched on this a little bit on the last call, but we've got some other data that we're going to share with that idea. We're also going to talk about some volatility. But before we get to that, Bill, I know you and Carissa, you participated in something called the Big Slick. So tell me about that.
Yes. So I've recently done a social media post on this. I think the team, LinkedIn and Facebook. So if anybody wants to go back to that under my personal Bill Keen, actually Keen Wealth's main page as well, and my personal page, it's out there. But we're very, very fortunate. We have some in Kansas City, some celebrities that originated from Kansas City, one being Paul Rudd, another Jason Sudeikis, and several others. Heidi Gardner did a long stint on Saturday Night Live. David Koechner as well. I think he's from Tipton, Missouri. Eric Stone Street is here, lives here in Kansas City, from Kansas City. And about 17 years ago, several of them got together and started a small poker tournament, and they wanted to raise money for Children's Mercy, Children's Hospital here in Kansas City, really, really a renown across the country, and to support research to fight or eradicate pediatric cancer. So wonderful cause. And that particular event, they called it the Big Slick. And the Big Slick is actually a poker term. Did you know that, Matt or Steve? The Big Slick is a poker term. So Paul Rudd personally told me that recently, and I guess I should share why I got to talk to Paul Rudd recently. So they've continued on. It's no longer a poker tournament. It's evolved into a large gathering. This last year, they had their fundraiser, and all of the people I mentioned were present. They put on basically like a variety show, and it was held at what we call the T-Mobile Center here in Kansas City. I think there were 6,000 folks there.
It's a big event,
or so. Yeah, Jason and Travis Kelce, Mahomes, Al Roker was on site.
Was Taylor there?
Taylor was not there.
There was no
Taylor was not there.
camera on her, whether she was there or not.
Yeah, exactly. Al Roker was even there. He comes in each year.
Yeah,
Johnny Knoxville was there.
Others,
and I actually did a social post on this. It was 6 months ago or so, because one of the things that they were auctioning off, funds will go to 100% to Children's Mercy. One of the things they were auctioning off that night to raise money, amongst many other really cool things, was this movie that's coming out, or it actually came out on December 25th. Some of you may have seen it or heard about it. It's called Anaconda 2. It's kind of a remake from a movie called Anaconda that Jennifer Lopez was in and Ice Cube was in, I think about 30 years ago. And I don't know if it was so bad it was funny, or if it was meant to be a horror.
I'd probably categorize it as that. I don't think it got good reviews.
It did not get good reviews. Okay. Yeah. So Paul Rudd and Jack Black, and multiple others, but those were kind of the two main stars in this movie, have put out a movie called Anaconda 2. So that all the excitement was happening, and they were auctioning off being able to travel to LA for the premiere opening. They call it a red carpet premiere opening, where the cast themselves and some of their friends get to watch the movie together. The first time they've collectively actually seen the movie, the stars and cast, but then allowing others to come as well. So this is something, I'm not a red carpet person. I've never done anything like that. But Carissa and I bid on that night, and we won. We won along with a couple of couples. So we traveled to here just a couple weeks ago to Los Angeles, and we were greeted by gracious hosts there on Saturday by Mandy Rudd, Paul Rudd's sister, and her fiance Dave. Just great folks. And we made our way over to the theater. I think it was called the Broadway Theater. It was an iconic theater. I think it sat about maybe 600 folks or so. So not a huge theater, but it was just ornate inside. But we got to pull up in the black Suburban, get out the red carpet. All the paparazzi are there. Cameras are flashing. People are trying to get autographs and hollering and everything else. And we were just escorted in to the red carpet area by Paul Rudd's handlers and Mandy and Dave, and got to go onto the red carpet and get pictures. We got to chat with Paul Rudd. We got to chat with Jack Black. We got to see all the other cast members and really have a special night. The dress for the evening, Steve, was smart chic.
Smart chic.
Was that on
yes, it was. Yes,
wow.
Yes, it was.
Okay.
We got the invitation, and we're looking at this.
Did you know what that means, or did you like chat GPT it and see what smart chic means for?
We're from Kansas City, and I'm not like I said, LA red carpet smart chic person. So we had a little help from a couple of consultants here in Kansas City.
Yeah, you got your haberdasher that you go to.
Yeah, I've got a guy, as they say.
You got a guy,
and so he I think he did well. So, and I did run it through Chat GPT. You take a picture, and if you take a picture, and it'll tell you if that's smart chic or whatever.
Okay.
And you can also just upload what it is you're wearing, like, type the words. And it said that what I was planning on doing was going to be a power move, but not too much for the red carpet opening in Los Angeles.
Man.
It did. So I'm going to suggest that for this episode on our show notes that we use the picture. We use a picture every 2 weeks. We use one of the pictures of Carissa and I and Jack Black and Paul Rudd. What do you think? Will we do it?
I think we'll do that. I think we're going to make an executive decision here and get that done.
Man.
Okay, so all the viewers and folks that follow our materials can get on there and see, or go to my social posts, like I said, LinkedIn and Facebook. So we got to go there. They were extremely nice, very grateful. Paul specifically thanked us for the support of Children's Mercy and some of the other work the Keen team does in the I think someone had briefed him on us. The work that our foundation does in the community here in Kansas City, and gave us a lot of time on the red carpet with him and Jack. And then we got to go inside into this theater of about 650 or so and literally watch the movie with them. They were just one row over from us. And it was Mandy and Dave, Paul Rudd, Jack Black, Ice Cube, because he made a cameo in this movie. And then my party we were just right there. It was crazy.
Right there. Yeah.
So, and then in the after party, Paul was kind enough to talk to Carissa and I'm not kidding, for no less than 20 to 30 minutes, and just, was super kind, asking us about our lives and our families and asking us about the work that we do. Had found out that because of that donation that we made to Children's Mercy, they reached out to Carissa, and then Carissa connected them with Angel Flight, because now Angel Flight, because of that connection, is going to be doing more flights for children in need that aren't able to get to Children's Mercy in Kansas City. So it's like this full circle thing. And Paul was really excited to hear about that connection as well. Just kind of how it's all tied together. So, no, it was a wonderful time, and all in the spirit of taking care of our local community. And if the byproduct was we got to have a fun night like that, but it was fun, and again, shared all those kind of a few videos and pictures there on the social media posts. So it was really, really cool. And it was really, really good. Finally to say, there were Make-A-Wish kids there. There were others that were coming there. And I just saw Paul and Jack take all the time that they had to spend time with those families. And people were yelling at them to come on, we have to go, their handlers and others. And they just kept spending time focused, and it was really heartfelt, like to see the sincerity in them.
Very nice.
One of the videos I uploaded on social media was something I found online that the paparazzi, I suppose, took. It was a video of me and Paul and Carissa and Jack on the red carpet, about 15-second video. So we were able to put that on the social media post as well. But anyway, I was a star for a couple minutes, or at least people thought. What was funny is
Bill,
they were
you are
taking
a star.
pictures. People were taking pictures of Carissa and I, and then I think realizing later that we were really, anybody that they were worried about, but we still made it on some of them. So that was good.
Man.
But anyway,
that's
thanks for
very
letting me
cool.
share that, because that was a really cool kind of outcropping. And Children's Mercy here was just at the office a couple weeks ago talking about next year's event and how we might be able to lean in a little bit more even next year and just try to help them on their journey to eradicate pediatric cancer. So good stuff.
Yes, a very worthy cause, and just great to see the few folks there in Hollywood that are really getting behind it and giving back to the local community. Because I think you mentioned Paul is from Kansas City, Paul Rudd.
That's
He
right.
is, yeah. And he actually graduated from 87 from high school, from a competing high school. So we were exactly the same age.
Oh, okay.
For what that's worth,
For what it's worth. Yeah, that's great.
Yeah.
All right. Excellent. All right. Well, let's jump into a couple of financial related topics here. So one Dow 100,000. So Matt, tell me more about that. I think you'd mentioned earlier that you were getting some questions from folks like, really? Dow 100,000? That seems like a big number.
Matt, did the Dow hit 100,000 since I was in LA? Did I miss that or no? We're just talking.
If it did, I don't think it was an accurate print.
Okay. All right.
Sometimes that happens.
Not quite that quick. Okay.
When we have our events at our office, people come and especially our holiday open house, that's, actually in our physical location here in Kansas City. And I have my hat, my Dow 100,000 hat, and I have it sitting out. It sits out all the time. And
I see it right now.
it just gets so much attention.
I think you might as well go ahead and put that on.
I'm going to mess
It's an
my
oversized
hair up,
hat.
Yeah.
That's as your head continues to grow in size, Matt.
That's right.
You got room to grow into it.
Dow a million. I'm going to have to get a bigger hat for that.
Oh man, now you're stretching our thinking.
Yeah, everyone comments on it. I mean, even we have any visitor, they always get a kick out of that. But the comments always are, gosh, Dow 100,000. I'll never see that in my lifetime. I mean, I heard that at least a dozen times. And then we've talked about it, but it's just, it's so hard for people to see that or to think about that. And, part of it, I'm like, well, where the Dow's at today, don't you? It's almost 50,000. It's almost 50,000, right there. Intraday high in early December was like 48,800, so
it rounds to 50,000.
Certainly.
It does. Definitely.
When it's over 50, will we say it rounds to 100? Yeah.
Yeah.
Well, no, because 45,000 rounds, 45,000 plus one rounds to 50.
Okay.
50. I'm not going to
Steve's
round 50 to
arbiter
100.
of rounding here.
That's right. Yeah.
That's right.
I'm the rounding referee. How's that?
Yes.
But what I like to do too, though, is put it in perspective when I answer that, because it's like, well, the Dow, it came out when it came out. Gosh, what's it been around over 100 years? It's been around for quite some time, and it
goes back to the 1800s, I think.
Yeah, and it's been right now it's 30 stocks, and it has its weighting, which is a little unique, but those stocks haven't all existed in the Dow the entire time, because many of the companies back when it first started don't exist anymore. Some of them got bought out, others went bankrupt, but they replaced them. That's just how things happen. Companies get replaced. That's a normal thing to happen.
The Dow Jones started with 12 stocks in 1896, expanded to its current number of 30 on October 1st, 1928, creating the Dow 30.
There we go. 100 years for that 30
That's
stock average right there. But when we went through, because it wasn't that long ago where we went through Dow 10,000.
Mm-hmm.
That was in the late 90s. And then we went through Dow 20,000. That was in 2017. Dow 30,000. 2020. Dow 40,000. 2024, May of 2024. Dow 45,000. That was December of 24. Now we're very close to Dow 50,000. So it's like, okay, well, what would it take for the Dow to go to 100,000? Because again, the comments are, it's not going to happen in my lifetime. So let's just assume they're thinking 20 years as a lifetime, because most of these folks are retired. They're in their 60s. They may be thinking longer than that, but let's just keep it simple and say 20 years. Well, if you look at the compound rate of return on the Dow, and what we can slice this up in so many different ways, but there's long-term averages, which we have the numbers on. But I also looked at, okay, well, when it passed through Dow, the Dow passed through 25,000 to where it's at basically today, Dow 50,000. It's, not quite there, but right, real close. That was a double. So Dow 50, Dow 50,000, Dow 100 is going to be a double. Well, the Dow passed through 25,000 in January. It closed. It kind of passed through it intraday slightly before that, but it closed above 25,000 January of 2018. So
Okay.
it was we're roughly 8 years. Not quite, but real close to 8 years on that. And there's calculators that will tell you the rate of return for the Dow in two different ways. One is what we would call like the price return, which is just not including dividends, because we know a lot of investments pay dividends. The Dow, if you were to invest in the Dow or a Dow, ETF that tracked the Dow, you would receive dividends, which can also be reinvested, or also, they're part of the return that you receive. But let's just say point to point. Well, from the time it took from January of 2018 to where we are now in December of 2025, that was just over an 8% compounded return on a point-to-point basis. Now, if you factor in reinvesting dividends, so you were taking a dividend and just buying more shares of it, which again, that's real common for people to do, especially while you're working and saving still, that's a 10% compounded rate of return over that period.
Okay.
So if we just use those rates of return and we say, okay, well, if the compounded rate of return from where the Dow's at to get to Dow 100,000, let's just use 8%. I mean, we have financial calculators. There's calculators online. We have our trusty financial calculators that we've been using our entire careers. It would be just over 9 years.
Yeah.
9 years. And I mean, the people just they just can't fathom that. Part of it is because they anchor to back when it was lower, even though it's where it's at today. I mean, from the reason I pointed out Dow, when it passed through 10,000 late 90s, that was a big deal. What's up 5X from there? And we're
Matt,
just talking about a double, not a 5X. We're talking about a double. But when the numbers are smaller, even though 10,000 is a large number, when they're smaller, a double, a 5X doesn't sound as dramatic.
No.
But it's still the same rate of return. And then if you use a 10% rate of return, it would take 7.5 years.
Yeah, I'm going with that. I think that's probably what it is. When I got in the industry, the Dow was 2,900.
Yeah.
2,900. Now I'm dating myself a little. It's been almost 35 years, but 2,900 to 49,000. I still got a ways to go here.
That's
I'll be working. I promise you, when it's 100,000, I will still be.
I mean, that's the power of compounding for one, because that's what's happening is it's compounding this entire time, and it just gets bigger. Now, the next common question is, well, why does it have to go? Because it's just the thought process is, well, because it's large, it has to go back down. Like there's some set point that it's expanded beyond for some reason. Like 50,000 is just too high, and I understand where they're coming from, because they're just, they remember when it was lower.
Well, it's funny, Matt, they split stocks sometimes when it's doing nothing to the valuation of the company, but it makes it from a perception standpoint cheaper.
Oh yeah.
Twice the shares, half the price.
Yep.
But it's Isn't that interesting how they do that?
There
Right.
is there's a behavioral reason that companies like to do that, because it makes people think it's cheaper because the share prices, because we think of things like we're buying something, at a grocery store or whatever. And it's like, well, yeah, if box of cereal is $5 and it goes on sale for $2.50, well, yeah, it's cheaper. You're not getting anything different. You're just paying less for it. Now you could also say, okay, well, what about, you're buying a vehicle? Well, vehicles today are much more expensive. However, you're getting a lot more technology with it too. So it's hard to
Safety
compare kind of
features.
apples
Yeah.
to apples on some things,
Mhm.
but food's an easy one. Maybe quality of food's slightly different, but cereal's pretty simple. It's probably been the same kind of cereal for quite some time. But you're just, but the Dow and when you're investing, what you're buying or what it's representing, the index is representing, is a reflection of the earnings, the underlying earnings that the components make up. And that's
Productivity.
why it goes up. Companies are larger, they're more profitable. And that's what happens. So that's what, when I do my webinars, every quarter, I have a slide in there that is a forward-looking projection of here's where current earnings estimates are, and let's apply a multiple, because that's how stocks, how the market functions, is the price you pay today is a multiple of future earnings. And even in the most recent webinar that I hosted, and I talked about, it's not like there's a standard multiple that everyone uses. I mean, the multiple is a variance of a lot of different factors, and every investor or institution, they all get to decide how they want to weight all the factors. So there's no set structure around it, but it's it is still, though, it's like everything's a multiple of earnings, and then when you collectively put everyone together, it's like that's what it is today in the moment. But we can use those multiples and determine a range of where we think future values are based on, what current estimates are for corporate earnings. Now, those estimates will change, because as we get closer to the earnings actually being realized, well, we have more data, and that becomes more real. And then, of course, after the quarter happens, well, now you have the real earnings. Like, it all just becomes real. And now analysts make, future estimates. The companies make, they make projections too, and they share those projections. They have calls and they talk about their outlooks. All those things are all kind of components of this. And it's a dynamic process, but we can always make adjustments and, ranges based on where things are at. And two, a lot of what I talk about is like, okay, well, what are the big factors that influence earnings? And one of the biggest ones that I comment on is, well, the state of the economy, but also the state of the jobs market, because corporations, what they do is they sell products and services to people for the most part. I mean, some of them just sell to other businesses, but then those businesses generally sell to other people. It's all kind of all intertwined that way. And if people have jobs, they have money to spend. And when they're spending money, that typically shows up as earnings for corporations. And that's, it's a very simplistic viewpoint, but it does give us just a general sense of what direction things are headed. And, it's been when I look back at our old webinars and the data points in there, the market multiple has been fairly consistent. I actually mentioned this in the webinar. The December of 2024 forward-looking outlook that I mentioned, and the high end of the multiple was a 24 times whatever those earnings were at that time. And I talked about the S&P 500 a lot on the webinar, and the year-end kind of price target, or the 12-month price target based on that multiple. You guys want to guess?
For
I think it
the
was
Dow or
60
the S&P?
For the S&P.
For
So
the S&P.
yeah, so Steve, Matt did his webinar, I think on December 18th, and it's a quarterly webinar. On the December one, the fourth quarter one every year, our team also then does a holiday greeting. So I did about a 5-minute little introduction up front. The whole team takes some really fun pictures. I had my whole Keen family saying a little message. It's a really fun holiday intro. And then Matt does his outlook for the next year. And so if you haven't gone back and watched that, I would recommend taking a look at it. Did a fantastic job.
It's on YouTube, on our website. Yep.
Yeah, YouTube website. I walked through you'd love this, Steve. I walked through our really awesome kind of training room that also has where we eat and gather and fellowship and have lunches and things. The entire team was out there. It was silent, and they all were watching Matt's webinar. Pretty cool, huh? Because, the planners and everyone is watching Matt's webinar. So very cool. And I was going to say, I watched that, I know because Matt's prediction, he never brags on his predictions because we don't purport to have a crystal ball. But I believe you said 6,600 back at the end of 24 was what you were projecting for the S&P at the end of 25 was 6,600. Am I correct? What is it?
It was slightly above when you look at
6,800.
The exact math, but that's where it's at today. Not to say
that's where it's at
for the S&P 500. So it's like it's because I'm using earnings estimates and I'm applying a range of multiples too. I don't just give one price target. I give a range. Because if things start to slow down, then we start to I think we'll be more towards the low end of the range. But based on where trends are and where things are, here's where we kind of see things headed.
So in your webinar that you just did here, December 18th, I think you said, Bill. So you put a projection in for 2026 for the S&P 500?
I did.
Okay. I've not seen this, so I've not looked or anything. I'm going to guess that you said somewhere between 7,500 to 7,800 on the S&P.
So the low end was actually a loss. So let's, so on the low end.
Yeah.
So it was about down 12%. So it would have been, in the 6,600 on the low end, all the way up to 7,900 on the high end.
Okay. And
so very close sort of to where you had, Steve, is the kind of middle of the road.
So do you have a base case and say our base case is it's going to be here and here's the high low? Or do you just say it's the range of from down 12% to up 12%?
So where I will point out to where I think we'll end up based on where the trends are, and I believe we'll be closer to the high end of the range than to the low end of the range. Yeah, based on just again where things are trending and how we see earnings shaking out throughout the year. Because again, it's a function of earnings. Now, let's just say, and I mentioned this in the webinar, that if all of a sudden we start to see job losses, here's what's going to happen. Estimates are all going to be updated with much lower numbers, which means that's how that multiple starts to trend down, because now we have projections that are negative. But it also goes both ways, at least from the analyst community, because they're the ones who are collectively creating all these estimates that I'm using. It's not just one person or one company. It's a collection of these analysts. When things are bad, well, they kind of tend to just assume they're going to continue to stay bad. It's an interesting kind of dynamic. I mean, they don't project that future earnings are just going to go to zero, but they don't assume that there's like bounce backs in the economy sometimes. Some do, but it's funny when you look at like the big like brokerage firms and they come out with their price targets for the future years. Like you can see where, well, when years are poor performing, most of them don't really go too far out on a limb and just kind of show like a very small gain over the next year. And then when things are really good, sometimes it's like they try, it'll continue. It's just,
it's Dow 100,000.
So not, maybe not as intuitive as, where I like to look at all the data and everything else. And not to say there's not people at those firms that are doing that, but publicly when they're putting that stuff out there, they're
right. Well, let's
muted.
Let's be realistic here. Wall Street people don't get paid to be pessimistic.
Well,
They get paid to be optimistic.
Buy or hold.
The worst they'll say, exactly. No sell, right? So they always are going to have an optimism bias, which historically has proved to be accurate because markets have historically gone up over time. So from that standpoint, it doesn't pay to be pessimistic. I do want to go back to something, Matt and Bill, if I could for a second, because Matt, you had shared some data with us here that I'm looking at, and it shows that the Dow first hit 1,000 back in 1972. Yeah. And then it first hit 5,000 in 1995. So from 1,000 to 5,000, that's a 5 times return. Okay. Took 23 years.
Yep.
Now, interestingly, how long do you think it took for the next 5x return to go from 5,000 to 25,000? Well, I know you guys know the answer.
We know the answer.
That's right. But for our listening audience and our viewing audience, the answer is 23 years.
Yeah. The same.
So, yeah, exactly the same. Okay. Now, what you may not know, I'll test you on this one. What is the compound annual growth rate to go a 5x in 23 years? What's that rate of return? I did it on my calculator here.
It's over the long-term return of 10%, or is it not? Is it close to 10 or 11%?
Lower than that.
Yeah, I think
it's lower.
Price is about 6 something.
Yeah, 7.25%. Yeah, 7. Okay. So a 5x return in 23 years, 7.25%. So let's say that the trend continues and it takes 23 years for the next 5x, which means to go from 25,000 in 2018 to 125,000 in 23 years would put us at 2041.
That's right.
The year 2041, we would hit the next 125,000 if it took another 23 years like it has for the past two 5Xs here, starting with Dow 1000 in 1972. So
this is 5X, not 5%.
This is 5X. No, this is 5 times. This is 500%, right?
Yeah. Yes.
And so 23 years is not a long time in terms of a lifetime necessarily. And I would imagine that many of the people listening to this, hopefully the 3 hosts here as well, will be alive and kicking and well 23 years from now to be able, if this trend holds true.
We'll be recording our podcast, Steve.
That's right. That's right.
Yes.
We.
Well, if you think about it another way, if we're at 40, let's just say we're at 50,000 now. And it goes 5x in 23 years, right? If we're at 50,000 now,
250,000.
250 in 23 years.
23 years from today.
From today.
What was that? 2048.
The question is, why is all this
maybe
matter?
2049 if we're in 26.
Why are we talking about all this? And it's fun to think about and stretch our thinking. And we're not really stretching our thinking, although we are, but it's not anything outlandish that we're speaking of. It's just historical averages, really.
Yes.
But it's because most of, I would say every single person likely that's listening and viewing our program today are participating in the capital markets.
Yes.
Are owners of these securities. And these securities, these investments, if diversified appropriately, and you have the appropriate emotional relationship to them, probably and hopefully with a compassionate, educated, wise fiduciary advisor helping you get through some of the times where it's not just going straight up, where you're going through some downturns. This is a very, very powerful wealth building mechanism, not only when someone's building wealth to work toward retirement, but in retirement as well, to outpace inflation and for that portion of your portfolio to be a growth engine for you, to help keep pace and help be able to provide income later in life as you need it to live on and not outlive it. And in a lot of the cases, or most cases, in our case here at Keen Wealth, a lot of our clients have more money at the end of their life than they've ever had in their lives as a result of just a smart and prudent allocation between stocks that we're talking about today, diversified appropriately, of course, and fixed income of just in some percentage. And that's why we're talking about it, because this is a tool, this is a vehicle. These are things that we're all exposed to, likely all of us are exposed to, that we need to understand and have some idea about how these things work.
Well, and with that, with that, it's not a straight line. from
right.
1,000 to 5,000, from 5 to 25, and 25 to 125, and 50,000 to 250,000. So let's talk about volatility a little bit as we get ready to wrap
The
up here, Matt. I
price.
know you've got some data here on volatility. So
It's the price to
I
be
think
paid
that's
for
important.
the long-term wealth
Well,
building opportunity.
because
for
we
sure.
talk about the compounded, the average compound return. That doesn't, that the reality is it doesn't just tick off that way. You don't earn 8% every year and it just like clockwork. You have years where it's significantly better, and that's most years. And then you have years where it's down, and it's temporarily down. We've never had a market that was, a diversified, an index or a benchmark that went to zero. We've had now I can say this, interestingly enough, I mean, we've had benchmarks and ETFs that have halted, like the Russian ETF, because they just got delisted. But, big major corporations that are headquartered here in the US, when you have a diversified portfolio of them, that bucket is not going to zero, assuming you're diversified correctly. And so those declines are temporary. But that's the thing. We're not, humans are wired to be, those are scary, and it's natural to feel, to be nervous, feel anxiety, and then start to pay more attention to the financial media, thinking, hey, I need to be paying attention to it. And all they're doing is just telling you how terrible everything's getting. That's, kind of why we were talking about those, major, wirehouse firms, but also it's just like when things are bad, the predictions are, well, it's only going to get worse. And it's easy, because human nature is the opposite of the analysts. Like, they're not optimistic. Human nature is more pessimistic to say, well, I don't see how it's going to get better. I mean, the most recent, significant event that we had was COVID. And the market, the intra-year drop. We started the year in January, of course, and then COVID happened. Market dropped at a low. This is the S&P 500. It hit at a low minus 34%.
In a very short time, right?
Yeah,
a couple weeks.
That was very quick.
Yeah.
Yeah. It ended the year up 16%.
So from the bottom,
add them together.
From the 36, wait, no, it had to go up 36 and then up 16 more, right?
Yeah, 34 plus 16. It's a 50% change.
From the bottom. So imagine if you were panicking, thinking the world was coming to an end, and you sold everything out.
And the, the most common thought process is, it's going to get worse. I need to sell now and I will get in later. I mean, that is like clockwork. Either people think that, may not communicate that, but we also have conversations with clients, and that's a common conversation. It's going to get worse. I don't see how it's going to get better.
Not as much as folks would think, though.
And what it is it's like, well, you may be correct in terms of whatever the situation is. COVID itself may not be getting any better. It's the stock market we're talking about, and that's a whole different animal.
You have to bifurcate
That's
those,
what we're trying to divorce, the link there, because the market, as we talked with our earnings estimate, it's a forward-looking mechanism, and investors are forward. They're like, oh, well, down 34%. Now, of course, something happens, whether it's a change in mindset, maybe there's a law change, which happens sometimes, and that's just a spark that all of a sudden gets everyone, on this, hey, things are going to get better. They're going to get better, at least from an investing standpoint, and people start buying, and then that trend just continues. And so that's how you have to think about these things. So when I have the webinars, and definitely during COVID, we had a lot of webinars.
We did weekly town halls.
Yeah.
Yeah.
It's all about, especially when we're going through those pullbacks, they're opportunities for people that are adding and have cash to deploy, or if you're structured correctly, rebalance into, that's definitely a massive opportunity. But they're also, we have to think of those things as, what are the forward returns from here? Not anchor back to, well, it's down 20%. It's well, what 12 months from now, 18 months from now, 24 months from now? What are the forward return expectations from there? And that's why we pointed out, well, in COVID at the bottom, minus 34%, at the end of the year, up 16. That's a 50% return.
Yeah.
from that point forward. Now, and then if you look at the next several years, it's compounded over. That's why the Dow's at 50,000, because it just keeps compounding off those numbers.
Now, Matt, you talk about COVID, but even this very year,
this
very year, so we can't
forget about
do
this
not
year,
miss the lesson. That's the thing. We always want folks to do not take diaries, read this, or go back and watch our webinars and podcasts. And it's a diary, or take your own. That's why I did the second edition of Keen on Retirement, because I wanted us to not miss the lessons that we hopefully learned and took note of during COVID. But this very year, we had I don't know if we coined the word tariff tantrum or that was out there, but the tariffs created massive uncertainty. We had intraday volatility down 20% this year. That's right. In April, the S&P was down 20% intraday and closed down 19.
Yep.
And then ended up, it's a very similar story to COVID.
Yeah, mid-December, the S&P's up 16. That's a 35% swing.
Had you sold everything when you thought the tariffs were causing the world to come to an end? Look at those moves. Those are devastating moves to portfolios too, by the way. These are things that some people might not recover from.
Yep.
If you allow your emotions and you're not being guided and counseled and have folks that can help you walk through these things, those can be devastating.
Yeah, and the wisdom, the takeaway is the downside. When we have these downside events, that's actually normal. That's the wisdom. That's normal. It doesn't, whatever the headline is, it's always going to be different. And, again, I'm referencing the webinar a lot, but it's like I talk about all kinds of different headlines that are on people's radar. It's the ones that aren't on people's radar that really have the biggest impact, because no one's expecting that. Or, it might be a small, tiny, minuscule, really, real risk that turns into a much larger real risk very quickly.
Well, think about planes flying into buildings. I mean, God forbid, no one could
you have that. But you also had in 2022, the Fed expectations where they were going to raise rates 1% by the end of the year. Well, at the end of the year, they were up 5%. It was different. No one had that on their radar that they were going to raise rates that quick, and that impacted the markets temporarily.
Mm-hmm. Well, I think I got a great quote here to end our episode, and I know in our next episode that we're going to record, we're going to talk a little bit about some quotes, but I got one here that I think I'm going to pull out since I got it in front of me here to end us here. So this comes from Bill Miller, and Bill Miller is a famous investor. He was a mutual fund manager, and I think one of his claims to fame is he had a streak, and I want to say it was about 15 years in a row where his mutual fund outperformed the S&P 500, which is just a phenomenal feat. So somewhere around 15 years, I don't think anybody has come close to matching that since then. So what he said was, all of the great investing periods begin when things are terrible and end when they are wonderful. So it's that contrarian thinking here. So we've been talking about how we're, as human beings, we tend to think what's happening right now is just going to continue to infinity. So when the market's going down, when the market's going down, we think it's going to keep going down. And when the market's going up, it's going to keep going up. But it's actually when things look their worst, then that's the time to get in there. And I remember an old saying from an old stock market guy back in the 1990s. He was telling a little story, and he said, when I was a broker, he said, I used to tell my clients that there's going to come times when you're so upset with me, you're so upset with the markets that you want to come by my office and you just want to throw a brick through my window. And he said, what I tell them is, I said, when you throw that brick through my window, make sure there's a check attached to it, because that's when we need to be investing in the markets. And it's like, I think that is so true. Now, we don't encourage people to throw bricks through windows here. We do encourage people to bring checks in and get them invested in the market. So
we'll take a check, though.
Oh, yes. We'll take a check. That's right. So, all right. Well, guys, I think we're going to wrap there. Another great year for the markets, another great year for Keen Wealth Advisors, a great year for the podcast here. And hopefully it's been a great year for each of you listening. We wish you a wonderful 2026, and we're going to be right back at it here with the next episode in early mid-January here for 2026, and look forward to another great year of episodes. If any of you listening have any questions, comments, observations, please reach out to us at keenwealthadvisors.com. And We'd love to hear from you, and I'll let you guys each have the last word. So, Matt, just one quick, short comment, observation. What do you want to leave us with here for 2025?
I think 2026, it's going to be the best year ever.
Best year ever. Perfect. Best
year
year
ever.
yet. How's that?
Yeah.
All right. I
Bill,
love it.
What say
I
you?
love it. Well, I just wanted to say, as it kind of to tie a bow on our episode today, I think it's great to talk about the long-term history of the markets and the power of the wealth building mechanism that exists, and about the earnings and the underlying companies and the human capital and the assets that underlie all those things. And also, we touched a little bit about it's not a straight line. So just providing that wisdom and continuing to talk about that during the times that it's not going up, not to be afraid, to understand it's very normal, and there's ways to create opportunities during those times. And so to be able to navigate that with peace and intention creates the intersection and the possibility of just a really wonderful future. We've had the good fortune to be able to see that play out. Me personally, in the business for almost 35 years now, and families harnessing the power of that and understanding how the cycles work, and living some really inspiring, cool lives I've gotten to learn a lot from. So have a great 2026, everybody. It's exciting to be getting started off here in another year.
Perfect. All right. Well, Happy New Year, everybody, and take care.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.